While everybody's caught up into everything else going on in the world, the stock market is it's silently crashing without anybody even realizing it. Dell Technologies is down over 10 percentage points after hours, and I believe the loss has gotten a lot worse since I took that screenshot. MondoDB stock, which was a very hot stock in the market, fell over 7 percentage points here today. It's down another 23 percentage points after hours. Salesforce fell around 20 percentage points here today. That stock is now down 27% in the past 3 months, and that's a multi-$100 billion market cap company. Adobe stock, usually seen as one of the best stocks in the stock market, usually seen as one of the most stable stocks in the stock market, down 6.6 percentage points here today. It's down 24% plus so far for this year. Intuit, also seen as one of the best business models, one of the safest business models to invest in. That stock fell 5.9 percentage points here today. That stock is down 16.6% just in the past 5 days. Snowflake stock fell about 5 percentage points here today. It's down another 3 percentage points after hours. That stock is down over 27% so far this year. And after those after hour losses, we're probably looking at 30% down so far this year for Snowflake stock. Uber Technologies has fallen over 18 percentage points in the past 3 months. Shopify is down over 23% in the past 3 months. UiPath down 34% here today, down 50% plus year to date. I posted this inside the private stock group in the breadcrumbs tab last night. 5 famous stocks trading at near or multi-year lows. Estee Lauder, Whirlpool, we're also looking at Nike, we're also looking at Starbucks and Zoom, all at or very close to multi-year lows for all those stocks. The Dow Jones Industrial Average has lost about almost 2,000 points just in the past 10 days, not 10 trading days. I'm talking just the past 10 days. Ever since the market hit 40,000 plus, it's just been down, down, and down. And let me be very clear to everybody out there. This is what an index looks like when it's in complete free fall. This is what it looks like, folks. There's no stopping it. It's just a straight mountain down. The market is in free fall, and no one's really realizing it right now. So we're going to discuss a few things in this video. We're talking about what's going on here. We're talking about could this get worse? And the third thing we'll discuss is where should you be invested in this market? Because if you're invested in the right type of companies, you're not really feeling the pain, but it's a very select few, and so we'll speak about that. Public count here today, down 0.16%. I'm certainly not feeling the crash, but I can tell you if you're invested in most of these stocks out there, you are feeling devastated at this point in time. We got a lot to go through in this video here today, folks. Appreciate y'all joining me. All I ask in return is that you take 3 seconds out of this video here and go down, hit the like button, and make sure you're subscribed to the channel. That's all I ask in return. If you want to go further than that and you want to support my content, you can do so if you choose to, okay? That is the pinned comment down there. I'll put my Patreon. Haven't shouted that out in quite a while. We have a few different tiers. One is just to support my content. You don't get access to anything. The other is to see the stocks I'm buying and selling tomorrow and in future weeks, as well as be part of that Discord chat. And then the last tier, you get access to the stocks I'm buying and selling. You get access to that Discord chat, and you also get access to my Becoming Master of the Stock Market course. Okay. All right, guys. So first off, we have an overwhelming amount of data that is starting to go very negative for the economy. We have the dominoes all falling the wrong way. If you've listened to my channel for the past 7 or 8 years, I've warned countless times about when the dominoes start falling the wrong way, it's very bad because it's very bad. It's very hard to stop those dominoes, okay? And this is exactly what we're seeing play out. Let me show you the overwhelming data. Here we go. So, starting out here, University of Michigan consumer sentiment. We're in a very bad place when it comes to that, and it's nothing new. We've been in a very bad place when it comes to consumer sentiment for actually, a few years now at this point in time. We've been in this kind of troublesome area. So the way to think about this is University of Michigan consumer sentiment, and if you're over 90, that's good. That's like where you should be, good, healthy economy. People are feeling good about things. That's ideally where the U.S. economy should be most of the time, and that's where the survey should be, okay? If you're in between an 80 or 90, that's a moment where people are like, I'm not so sure about this thing. Like, it's not feeling great. It's not feeling horrible, but I'm a little uncertain, right? And then if you ever go below 80, that's bad. Bad, okay? And the further you go under 80 is bad. And if you look, we have not been over 80 since like 2021? 2021 pretty much, right? That's the last time we've been over 80. And the last time we were over 90 was back way prior to Rona, right? So let that sink in for a moment. The consumer sentiment is bad out there. Small business, which I've always told you guys, my opinion is the economy really runs on the back of small business. When small business is feeling great and doing great, that means you've got a truly great economy. When small business is not feeling great and when they're doing bad, that means your economy is not in a good spot. And let's be very clear, small businesses are not feeling optimistic about this economy and haven't been. And really, it's just been kind of getting worse here recently. So in regards to this index, anything over 100 is good. That means you got a good, healthy economy. Small business is feeling very good about things. Small business is feeling very healthy. When you slip under that 100 area there, that's when you got to start to worry. And when you go under 95, that's bad. Okay. We witnessed this, right? We slipped, if you look prior to the great financial crisis, right? If you look kind of 06, 07, we slipped under that 100 category, right? And then we kind of kept slipping, and the next thing you know, we found ourselves going down massively and massively, right? And as small businesses felt worse and worse, guess what? The unemployment numbers went up and up and up, right? And so we've witnessed that obviously transpire over the last couple of years here. So small businesses are in a bad spot, and it's showing no signs of coming back really anytime soon, right? Now, meanwhile, if you want to look at big companies, we do actually have some troubling things starting to brew in regards to big companies, right? And I'm seeing this from several of these big companies that just reported earnings. Now, you look at Meta, advertising giant. We all know it, right? They provided a weaker guidance than what was expected. Was it an off the cliff, like a horrible number? No. But it was still a weaker guidance than what was expected. And then Amazon came out, and Amazon also had missed their forecast when it came to revenue as well. So all of a sudden, we got two of the biggest, most important companies in the entire world when it comes to the economy, both with weak forecasts, which is troublesome because it really hadn't been like that for quite some time. So if all of a sudden these companies are feeling like, hey, you know what, business might not quite be there for this next quarter, that could be the start of things getting much worse for the following quarters, right? Then we had Salesforce last night. And Salesforce had a weaker outlook than what was expected. Was it an off the cliff like, oh my gosh, it's the worst number ever? No. But it's a trend that is like the first inning of like a troubling cycle of like, okay, weaker guidance. Then let's say these companies come out, report numbers that are kind of a little weaker than expected, right? And then they do even a weaker guidance next quarter. This is what I talk about when I talk about dominoes falling the wrong way and one topples over another. And all of a sudden you got this big bad situation on your hands. This is, these companies matter significantly, right? Then we go ahead and we look at somebody like a Starbucks. Starbucks revenues pretty much never go down. Like the only time I can ever remember Starbucks revenues going down was like in 2020 when like everything was shut down for that little amount of time. Other than that, I can't ever remember Starbucks revenues going down in my entire investing lifetime, which started back in 08, 09. Like that just doesn't happen. And so to see Starbucks revenues literally go down is like, what is going on out there? Like that's crazy, right? Operating income fell 17% for Starbucks. Starbucks reports a D income statement. What? That never happens, right? Was it just them? No. AMD, this is supposed to be a great growth company, and my gosh, were their numbers disappointing. We got this whole AI wave going on and all these sorts of things, right? And revenue went like nowhere for the company on a year-over-year basis. It's like, what? What is that, AMD? Then you had Whirlpool come out, and just when you think their business can't get any worse, right? Selling refrigerators and washers and dryers and all these sorts of items, ovens and microwaves, guess what? Their business did get worse. Their revenue went down again, right? They reported an F grade income statement for their latest quarter. You had Southwest Airlines report a D income statement here. You had Caterpillar. I don't even know how it happened, but somehow you would think like there's no way Caterpillar's revenues can go down. Actually, somehow their revenue actually went down for Caterpillar. That's still wild to me. If UPS and FedEx are ever seeing their revenues go down, it means you're likely in a recession or you're heading into a recession because these companies' revenues basically almost never go down. And if they do ever go down, it's usually because you're going into a recession or you're actually in a recession at that given moment, right? And if we look at UPS numbers, no. Revenue down over 5% year over year. Net income down 41% year over year. EPS down over 40% year over year. No, that should never happen, right? But maybe it's just UPS. What about FedEx? Maybe just something's going wrong with UPS. Well, the other giant, FedEx, guess what? Revenue's going down as well. Is it going down as much as UPS? No, but still negative on a year-over-year basis. If you ever see both UPS and FedEx revenues going down, it's because you're in a recession or you're going into recession. Like go back throughout all of history and look at time periods where UPS and FedEx revenues were both going negative. It almost never happens. And if it does, it's because you're in a recession, you're going into recession. That is insanely rare, right? Then you hear about this. Walgreens got to cut a bunch of prices on products. Target's cutting prices. Amazon's cutting prices. Walmart's cutting prices, right? And some people are saying this is good, right? And I can understand, oh yeah, it's good for the consumer, these sorts of things, right? Let's be very clear. This is not a good sign. This is not a good sign, okay? Do you think Walgreens, Target, Amazon, Walmart, do you think they ever really want to cut price? No. And they don't do this out of the goodness of their heart. Oh, our consumer, they've been hit a little bit. Let's just drop the price for them. No, give me a break. Come on, man. You believe that, you could believe anything. Come on, man. No, that's not the way business works. That's not the way these companies work. If Walgreens, Target, Walmart, Amazon had it their way, they would be able to go up on price on every single item every single day, okay? That's not the reality. When you see these companies, it's talking about, oh, we got to lower prices on 500 items, 1,000 items, 2,000 items, 5,000 items, whatever, right? We got to lower. They're doing that because their business is in a bad spot, and they feel they have no choice but to lower price. They feel like if they don't, they're going to get outcompeted, and they're going to lose more and more customers, which ultimately is going to cause them to incur losses or potentially have their net income go worse and worse, or revenue go worse and worse, and just end up in a really ugly, bad cycle. So I'm just telling you, Don't read all those price cuts. They're not being generous. They're not just doing that to do that. They're doing that because their businesses are looking out there and they're looking at what numbers are coming in. They're like, it's not quite there, man. We got it. We got to do something here. And so they're doing price drops, right? Not a bullish signal for the economy, folks. Not a bullish signal. So I just right there took you through an overwhelming amount of data, right? Now we'll talk about could it get worse, and then we'll talk about where you should be invested in this market. I just took you through an overwhelming amount of data that shows this economy is going the wrong way. And there's really no debating that. If you're going through all the data, could you say the economy is getting better or worse? There's no doubt it's getting worse, right? Now, that does not mean it's going to continue to get worse for all of eternity, right? And we're about to speak about that and kind of look to the future here. But the important thing is, at the moment, given all that overwhelming data I just took you through, that's bad. Dominoes are falling the wrong way here, folks. They're falling the wrong way. We are not in the right cycle. No. Okay. That takes us to inflation. And if we're wondering, could this get worse, right? Certainly, if inflation remains sticky as it's been, we're going to have more problems in the short term. But it's also going to lead to more problems long term, okay? We need inflation to be done. Because the problem is, when I took you through that overwhelming amount of data, there's issues coming up in the actual economy, right? But if you have inflation that's too high, then you can't really address those issues that are all brewing and stemming here and have really started in the economy. You can't really address those till inflation's really done. Otherwise, you end up in a stagflation cycle, right? Or you end up into a cycle where maybe you keep things going, but the inflation rate remains way too high, which ultimately leads to a very bad time out there, right? For everybody in general, right? And just kind of kicks the can down the road. So if this continues to be an issue, we're going to have much bigger issues, right? On top of that, Fed funds rate. Now, here's the deal, okay? Fed funds rate is insanely high for anything you base it on in the past 20 years, right? If you go back to the 1970s or 80s, Fed funds rate looks like it's not that high. Anytime in recent history, which is actually what matters, we're significantly high in terms of Fed funds rate. Now, the issue is the Fed's going to be able to cut at some point, but we don't know when that is. Is it 2 months from now, 3 months from now, 6 months from now, 9 months from now, 12 months from now? We don't know. But the bottom line is when the Fed cuts, it's not even going to really matter because it's like they're going to cut and we're going to be like there, which is still way above anywhere we've been in the past 20 years, right? And so let's say they cut a little more. It's like we're still going to be at insanely high numbers. So basically, Fed funds rate is guaranteed to be extremely high for at least the next 12 to 18 months. And the only way it really goes lower significantly from here is if the economy just completely falls apart and the employment market just completely falls apart, which that is something we haven't seen yet. But that doesn't mean we can't see it 6 months from now or 9 months from now or 12 months from now, okay? So far, the employment market has held decent so far, right? So that's a guarantee. And now where this leads to be trouble is let me give you an illustration here, okay? You see the guy with the big backpack, okay? So let's say this is how I would address the economy right now, okay? Let's say you're stuck in the middle of the desert, okay? And you have this massive backpack on that is loaded with stuff. And honestly, you can't get the stuff off your back, okay? That backpack represents the Fed funds rate right now, right? And it's holding a whole weight on you down, right? And so imagine you're going through this desert. It's like 115 degrees out. You got this massive backpack on you that you can't take off right now, right? And you're down to your last like couple sips of water, right? And then you're out of water. And you're just like, oh my gosh, I'm down to my last little bits of water and I got this massive heavy backpack on and I don't see civilization anywhere and I don't see water anywhere. Like, what am I going to do, right? That, unfortunately, is our situation in regards to the economy right now. We're on our last few sips of water to hold things together here, right? But we got this massive backpack on, which is the Fed funds rate that has continued to weigh on us. And we don't know if we're going to be able to take that backpack off. And we don't know if and when we're going to be able to get to water, right? Where are these sips of water at? That, folks, is where we have the trouble in this economy. That's where we have the major trouble, okay? And so it's very important to understand that, illustration or whatever we want to call it. I just ran you through there on how this could get actually a lot worse. We got the big backpack on. We can't get that backpack off anytime soon. And we're still running through the middle of the desert. And we're honestly on our last few sips of water here. No bueno. Okay? So could it get worse? Absolutely, it could get a lot worse, right? So the question is, where should you be invested, right? Because the first thing, should you be invested in the market? 100%, you should always be invested in the market, right? Always. You should always have some cash on the sideline. You should always have some cash earning you 5% plus right now, right? In a high yield savings account or a CD account. Beautiful. But you should always be heavily invested in the market, regardless of what you think might happen, might not happen, whether you think the Dow is going to drop another 8,000 points from here and go down to 30,000, right? Whether you think the Dow is going to drop another 18,000 points and go all the way down to 20,000 and blow everybody's mind, right? Whatever situation you think, you should always be invested in the market, right? Because the bottom line is a lot of people thought we'd already be in a major recession by now, right? Where unemployment would already be 9-10%. And we haven't seen that play out yet, right? We've seen things getting worse and worse and worse, but we still haven't seen that big unemployment cycle, which is where things really get ugly, right? Because when the big unemployment cycle hits, that's a whole different ballgame, because then people are, they lose their jobs. If they can find jobs, they have to get many times lower paying jobs. It leads to a whole dramatic situation. People can't buy cars, they can't buy homes because they don't have jobs. They have to burn their credit card companies, right? And then their credit goes to... And so therefore they can't get credit card loans. They can't get loans in general, which hurts the economy, because we know the economy runs on debt, right? If you're wondering, why did credit card debt levels, right, and many debt levels fall significantly after the great financial crisis? Well, you look back to 2011, 2012, 2013, debt levels had fallen dramatically. Why was that? You got to ask yourself, why was that? It wasn't just because people I don't feel like spending. I don't feel like buying a new car. I don't feel like buying a new TV. No, come on, man. You know why? It's because so many people had their credit hit significantly between foreclosures and short sales and burning credit card companies and going delinquent on auto loans and this and that during the great financial crisis, that coming out of that 2010 into 11, 12, they couldn't get debt even if they wanted to. If they wanted to go get a credit card, they couldn't. Banks were too tight. Credit card companies were too tight. It was hard to get loans back in those days, right? That was the moral of the story. So it wasn't like everybody just decided we don't want to buy stuff anymore. No, it's because they couldn't, because their credit was down to nothing, right? And at that particular time, the only way the banks would really lend you money, credit card companies, was if you had great credit and great job history. Well, if you lost your job, there goes your job history. You burn credit cards, you burn this person, that loan, this loan, boom, your credit's done, right? And in terms of some of those are major ones, like if I recall, foreclosure stays on your record for years and years and years. Like, it's not like it just goes away really quickly. And so, little food for thought in regards to that. So, moral of the story is, no bueno. Now, where should you be investing in this market? You need to look for one-of-ones companies, okay? This is what I call one-of-ones. Now, these sorts of companies are freaks, okay? That's why they're called one-of-ones. These are the superstars. These are, and when I say they're the superstars, it doesn't mean they're the biggest market caps, because sometimes these companies aren't the biggest market caps. Sometimes you could get lost in some of the biggest market caps out there and find yourself going down significantly on positions. Look at Salesforce, for instance, right? One of the largest market caps, and it's lost, 27% of its value in the past, 3 months or whatever that was, right? So it's not like that. One-on-one companies are companies that it doesn't matter what's going on, they're growing. It doesn't matter. Recessions, inflation, high unemployment, low unemployment, whatever, they put up their numbers. You're watching and you're witnessing countless companies' revenues start to go negative, right? We talked about Starbucks and UPS and FedEx, and I showed you a ton of those companies, right? But there's actually a significant amount of companies that their revenues are actually going up right now. And their profitability is going up immensely. That net income is going up and up and up. Those are special companies. Those are true one-on-one companies that these companies are the freaks. They're the superstars. These are the first round draft picks, okay? Let me take you through some of these companies. I'll explain why these companies are the one-of-ones, okay? Now, first one up here, Meta. Meta's a one-of-one, right? It doesn't matter what's going on. If you run any sort of business, you got to advertise on Facebook and Instagram, right? And you got to also probably leverage WhatsApp as well. And so when you think about it, it's the face of advertising. I was just, obviously, I'm sure you guys heard the news about T-Man, right? And rumor is, T-Man's websites for raising money are going crazy right now. They're even falling apart because so many people are donating so much money to him, right? Well, who's all that money going to actually end up in the hands of, right? Well, it's going to end up in Meta's hands. Okay? Don't tell anybody that. But it's actually going to end up in Meta's hands. Because when they get all this money, what do you think they're going to do with all this money? They're going to advertise. And you better advertise on Facebook and Instagram, because that's where, people are actually at. So, this, it all ends up coming back to Meta. This is a one-on-one freak company, okay? A one-on-one. PayPal. I know the stock price hasn't done much, but let me be very clear. It's a one-on-one. Look at the business fundamentals. Look at the revenue growth this company's been putting up, despite the inflation, despite the consumer getting hit, and yet they're still putting up great revenue growth. And they're putting up unbelievable net income growth for this company, right? Despite all the stuff that's going on out there, PayPal is a one-on-one. Amazon, a one-on-one. When you think about them from the e-commerce, it's like even in a recession, Amazon's e-commerce business is still going to grow. If bad things would have to get for Amazon's e-commerce business to go negative? I can't even imagine a situation where the economy went so south that Amazon's e-commerce business stopped growing for a year or for a few quarters. That would be really dramatic bad. So even in a recession, they're still growing. AWS is growing pretty much no matter what every single year, right? And already a ton of the companies already pulled back on their budgets big time when it came to AWS and those sorts of things back, a year or two ago. So now companies don't have as much leverage to cut AWS costs. Even if we went into a recession, the advertising business is going to grow no matter what, right? And so Amazon's a one-on-one freak company, right? Elf on a shelf. Look at everything that's transpired over the last several years, right? From Rona to, no one needs to wear makeup because they're all forced to be home, right? And look at Elf's numbers. They were still great. And then look at Elf's numbers with high inflation. Still great. People said, high inflation, that's going to hurt Elf because, their products are so cheap. So they're going to, these shipping rates and all this stuff, they still put up great numbers, even despite all that, right? They're a one-on-one free company with unbelievable growth rates that doesn't matter what's going on in the economy. They're going to do phenomenal, don't matter what. They're not reliant on everybody feeling great about themselves and all being millionaires, okay? Palantir, one-on-one free company. Look at this company. It seems like every other day we're hearing about another big deal Palantir closes, right? When you look at their revenue growth rates, you would think this is the best economy ever. Literally, you look at companies like Elf and you look at companies like Palantir and you look at their revenue growth, you look at their net income, you look at what's going on with their gross margins, you would literally think this is the greatest economy in history, okay? Literally, you would think that. When you look at most of these companies, you'd think, oh no, this is certainly not the best economy ever. But when you look at an Alpha or Palantir, you could get confused very quickly. You look at Amazon, you look at Meta's numbers, right? You look at PayPal's numbers, you would think this is the best ever. Everything's perfect out there. The consumer's got to be doing great. Small business got to be doing great. It's not. These are one-on-one freak companies that are putting up ridiculous growth rates regardless of what's happening. NVIDIA is the definition of a one-on-one, right? They got a freak CEO there who's top tier of top tier. They've got the tech. They got the overall team. They got the product concept that they've been working on for 20 years now at this point in time. And they got it all. And their customer base are the richest of the richest companies in the world. So they're in the ideal spot, right? They're a one-on-one freak. And their growth rates show, right? Their growth rates are astronomically high. Cheesecake, one-on-one company, right? I mean, my gosh, you think about how bad the consumer's been hit by inflation the past 3 years. You think about all that. You think about how bad consumer confidence is. You think about how bad the sentiment is from small businesses. You've got to think, oh, Cheesecake Factory, they got to be doing bad. No, they're doing better than ever. Look at their revenue growth last quarter. Look at their net income growth last quarter. Look at the comps restaurant sales for North Italia last quarter, right? And they're talking about expanding more than ever. They're a free company. I wouldn't want to be in the restaurant industry unless I was Cheesecake. They're a different breed. They're a different breed. They're run so much better than everybody else. They understand this business better than everybody else. The Fox restaurant concept side with the North Italia, the Flower Child, and everything they got going on there, it's leaps and bounds above almost any other restaurants out there. Never mind like mom and pop type places. So I wouldn't want to run a restaurant myself right now in this environment. Oh, heck no. It's brutal. Brutal. When you're dealing with inflation, you're dealing with high wages, you're dealing with a consumer that's weakened significantly. You wouldn't even know it looking at Cake's numbers. Look at their latest income statement. You wouldn't even know. You wouldn't know wages are high. You wouldn't know inflation's still a problem. You wouldn't know the consumer's been sliced and diced by inflation for 3 years. You would have no clue. That's a true one-on-one. Shopify, another one-on-one, right? This company, my gosh, they are small business. They are small business. And with small business optimism being so horrible, we looked at those numbers, right? They're around the lowest we've ever seen. And despite small businesses being in a bad spot, the company that caters to small business is doing better than ever, right? Shopify's numbers are phenomenal. Look at those growth rates. By the way, Shopify was another company that had, guess what? A weaker guide than what was expected. So that was just one of many companies, back to the whole economic weakness. But even with that weaker guide, it was still insanely high revenue growth, right? Way above any company in the market. So Shopify, recession, depression, doesn't matter. Shopify's growing, and growing. And the bottom line has ridiculous room for growth in the future years. And they got a CEO there, Toby. I mean, big boss. I mean, he understands how to execute on the highest level possible. So those sorts of companies, and it's not like those are the only ones, right? There's a few others out there that are those freak companies. But there's reasons I have money invested in these type of companies. Because these are type of companies that their numbers, their fundamentals are unbelievable. They're so leaps and bounds. You look at those companies I just ran you through, like my companies, and you look at the income statements these companies are producing, and then you look at many of these other companies. You look at these airline companies. You look at a UPS, a FedEx. You look at a Starbucks. You look at so many of these other companies, at McDonald's, and you're like, oh, I see why he's invested in these sorts of companies. These are best of breed. These are the sorts of companies that you would have no clue all this bad crap's going on. Because they're in their own league, right? They're in their own league. And so if you're gonna be investing in companies, I'm telling you, this is the sort of market you've got to pick the best of the best. You got to choose the best of the best. You can, there's other time periods when you're in such a bullish market and the economy's just getting better and the dominoes are all going the right way and unemployment rate keeps dropping and just like more jobs and there's more opportunities. We're in the opposite of that. There's, if anything, opportunities are starting to fall. Job openings are starting to fall. Like, this isn't even like opinion. This is just database. This is just facts. So everything's going the wrong way. And so when everything's going the wrong way, you better be very, very selective. You better be in the best of the best. Because if you're going outside of the best, in this environment, it's not going to end up good, right? You're going to end up and some companies that are going through some really tough times, really, really tough times, right? And there's a difference between a stock price going through a tough time and a business fundamentals going through a tough time. A stock market crash or major correction, all stocks could get hit. Big deal. There's a big difference between if your company's revenues are all going negative and your company's revenues are going positive, but the stock price is going down, right? I like it if I can be in a company and I can be buying a stock where their revenues are all going up, their earnings per share is going up, their net income's going up, but their stock price is going down because the market's weak. Bravo. I'll take that all day. Give me that. That's the best case scenario. You want to avoid the companies where the business fundamentals are not in a good place, okay, folks? That's very, very important. Very, very important. You got to be in the one-on-ones in this market. When I show you guys this little graphic over here, right? So I always talk about build a portfolio to be proud of years from now. And that's the key. You want to build an overall portfolio of great companies that these type of companies are going to be great 3 years from now, 5 years from now, 7 years from now, right? And I talk about buy the dip and never trip. And that's the same in regards to all these sorts of one-on-one companies. Like you could just, if you get those dips in those sorts of stocks, you got to take advantage of those because these are one-on-ones. And then imagine what these companies' growth rates will be when we are in good times again. Because I can tell you guys, okay? Consumer confidence doesn't stay low forever. Small business optimism doesn't stay low forever. Okay? These sorts of metrics, when they come back, when the economy and the dominoes start all going the right way again, which once again, that might not be for a year from now, 2 years from now, 3 years from now. But when that happens, imagine the sorts of growth rates these one-on-one companies will be putting up in that environment. If these companies can be reporting the phenomenal numbers they're reporting in a bad environment, imagine what they can do when everybody's feeling great, when spending's big, when people are feeling confident. That's a whole different ballgame in terms of what those growth rates will be in that environment, folks. And so you got to let that sink in for just a moment. Hope you guys got a lot of value out of this beast of a video here today. I appreciate y'all joining me. If you appreciate my content and you want to support me, do so with the pinned comment down there. You can click on that. You can join my Patreon. I got a $7 tier, which is just if you want to support. I got a $25 tier if you want access to the stocks I'm buying and selling each week, including tomorrow, as well as access to the Discord chat. And then I have the more expensive tier, which you also get access to my Becoming Master of the Stock Market course, which is insanely valuable for everybody out there. Okay. All right. Much love and have a great day.